How about the 9 winners? Let's start with the weakest of the bunch. Union Pacific, Nucor, and Emerson Electric, all of which are up 20 to 30%, better than the Dow or the S&P, but worse than the bulk of the Go list. So, I mean, but relatively to the rest of the Go list. But wow, these are very exciting. Like the rest of the rails, Union Pacific's been on fire for the last couple months. These guys report on Thursday morning, by the way. Railroad stocks tend to rally no matter what. That's because they do this precision railroading. It makes it so they're much more efficient than they used to be. Nucor, the best of the American steelmakers, got a huge boost in November after the vaccine data. And then another boost early this month after the Democrats swept the Georgia Senate runoffs. Wall Street's betting we'll get a big infrastructure package, and you can't build infrastructure without steel. Nucor is still a cheap stock, 2.9% yield. I got to tell you, I like this, especially for those looking for a cyclical that still has room to run. As for Emerson Electric, classic smokestack stock, they reported a great quarter in early November. Even before the vaccine, they were doing terrifically because they've got a ton of exposure to China, and we know China's doing very well. The stock's run from 65 in late October to 83 today, a new all-time high, and I think it's got more room to run. There's going to be a retiring CEO and a new one coming in who may break the company up. We don't know, but there's a lot of excitement here. Next up, we've got the middle of the pack, the Go list stocks that are up 30 to 40%. PPG, yeah, the paints, coatings, Disney, and Nike. PPG's paints and coatings are on fire. They've got a ton of exposure to the red-hot auto industry at the high end, particularly. They're also a big part of the home builders. Two terrific bull markets. While the stock's been on a tear, I think it's worth sticking with this one. It's really well run. Disney's a weird one. You'd think this would be a textbook pandemic play. Not a great time for the movie theater or the theme park business. But because Disney's launched a popular streaming service a little over a year ago, the stock quickly recovered from the March lows. Then we got Pfizer vaccine data. This thing caught fire is now trading like a reopening play. While Disney seems expensive on earnings, I like it up here. I know a lot of people want me to like AMC, which is a little stock that can run here. I don't know. It's the same group that wants me to recommend BlackBerry, GME. What else do they like? Whatever. All right. Palantir. I don't want to do anything more than say that's what they're thinking about, but I know that's what they're thinking about. Now let's talk about the kind of stock they should be thinking about. Nike. Even before we saw the light at the end of the tunnel, Nike was already making new all-time highs. As China bounced back and athleisure became the style of choice for people working from home. While the stock is expensive, Nike keeps shooting the lights out with spectacular digital growth. Yes, that is like Lulu. I know that, like Williams-Sonoma. These are all kind of well-run companies that have figured it out. Now, thanks to the pandemic, they've been able to cut out the middleman at Nike and sell their product direct to the consumer. We're not going back. Once again, I'd stick with Nike. It is the best direct-to-consumer story out there.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.